Welcome to the Statler Financial Radio Show with Philip Statler. Have a question for the show or need assistance with your retirement plan? Give Philip a call today. 863-285-3815. 863-285-3815.
Don't count your chickens before they hatch. You probably heard that one from your parents when you were a kid, and it's probably something you've told your own kids and your grandkids. So how do you keep from counting your chickens before they hatch in your nest egg? You're about to find out. Thanks for joining us today on the Statler Financial Radio Show with Philip Statler. He is president and CEO of Statler Financial Services. And Philip, kind of a fun topic here today, right?
It is. We're going to talk about, maybe people getting some more money in their paychecks.
Yeah, possibly. And here's the big lesson that we want to share today. And it plays out in a couple ways, I think. We're all familiar with that saying, don't count your chickens before they hatch. And I don't know, you've probably told your own kids this, but it applies to our retirement income in a couple different ways.
It applies to a lot of stuff, right?
Yeah.
And definitely retirement income, because as you get ready to retire, it happened to people in 2008, right? They were counting on that 401k being a certain amount, and then what happened? It wasn't there. It was maybe half of what they thought it was going to be. That's right. So then they had to regroup and refigure, and some of them had to put their retirement off for a few years because of that. So don't want to start counting your chickens before they hatch, because it can be problematic down the road.
Right. And here's another way, Social Security. Let's talk about that. We know there's a cost of living adjustment each year, and there was a recent estimate from the Senior Citizens League, which I think we've talked about these folks before, but they say there could be a 9.6% increase in Social Security payments next year. But again, don't count our chickens before they hatch. We don't want to assume that's the increase.
No, we don't yet, because it's not official, right? So there's still a few months of data to collect before they make that official announcement of what the COLA is going to be for 2023. So, it sounds good now, 9.6%, but it could be less than that.
Right.
And from the numbers that have continued to go down a little bit, I don't think it'll be more than that. So I think that 9.6 is probably a maximum number, but I would expect it probably to end up a little less than that. And then you got to take the other thing into consideration, and that's Medicare premiums, right?
Okay.
Medicare premiums are going to eat more of their Social Security because they're going to raise those as well. And so you may not get quite the bump you thought you were going to get when it comes to your Social Security.
Right. And let's just explain that a little bit more when we're talking about, because we had seen such a massive continued increase in inflation for so long. So the projections were that would continue. But now we did get some good news that it's starting to cool down a little bit. But that's what would impact not having quite as big of a bump in the COLA. Right?
Exactly. So they're looking at those inflationary numbers, the CPI, and they don't use the exact CPI. They've got some funky way of calculating, a special way of calculating it, right? So, so when they look at that, it's going to change as more and more numbers come out. And I can't remember exactly when they confirm what that number is going to be, but it'll be later this year before we get that. Right. And so we got a couple more a couple more inflationary numbers coming out before they make that announcement. Okay. So look, as we go through this situation, one of the things that's important is that Social Security is part of our income planning process. And so that means it's important that people have some kind of written retirement income plan in place. That's why we developed our core retirement design to help people design the retirement they always dreamed of. So they can give us a call at 863-285-3815 to schedule their core retirement design phone consultation, where we'll make sure that they're heading the right direction, that there's not any changes or peaks they need to make in their current situation to make sure they're ready for that retirement so they can have the retirement they always dreamed of. Again, that number is 863-285-3815.
Talking today with Philip Statler. He is president and CEO of Statler Financial Services. And I do want to ask one more thing about Social Security, and then we'll get into another area where this idea of don't count your eggs before they hatch, or don't count your chickens before they hatch. You can count the eggs.
That's right. Count the eggs.
Don't count the chickens.
They're not going to change.
That's right. How much should we count on Social Security for income in the future? Because I know I can go in and I can plug it into my 401k, and there's kind of like an income projection, and I can say, oh, here's what I think I'm going to get in Social Security. How much should we be relying on things like that?
I think it probably depends on how old you are.
Okay.
Right. And, I think that folks that are probably in their 50s can still pretty much count on it's going to be there. And some form of it's going to be there no matter what. Right. I mean, there'd be a revolution if they did away with Social Security. Right. So it's not going to go away. It will change over time. They will extend it. I think they'll have to extend what the normal retirement date is beyond the 67 it is now as we continue to live longer. But it's going to be there. It's going to be a leg of the stool for income into the foreseeable future. It has to be.
Yeah.
Just because of that. And so one way or another, it's going to be part of folks' retirement.
Okay. So just something to keep in mind, though, just be thinking about what those projections are. And good to point out that it depends on our age and just how close we are to taking Social Security. Here's the other area where our lesson comes into play. And I think this one is really important. How your retirement income will be taxed. We don't want to look at that 401k or our account balances and assume that's the amount we get to spend in retirement. This is where we talk about that nest egg, counting your chickens before they hatch with your nest egg. Tell us about the impact that those taxes can have.
Taxes can have a huge impact. I'm part of Ed Slott's Master Elite program. And one of the things he always says, he's one of the national experts when it comes to IRAs and 401ks and that kind of stuff, is that, that 401k, it's not all yours. There's a mortgage on it. Uncle Sam is part owner in your 401k.
Right.
Because every time you take money out, he gets his little share of it, and his share changes depending upon what the tax codes are at that point in time. It's always funny when I sit down with people and they say, well, I'm retiring. Taxes aren't going to be a problem because I'm retired. And for some reason, people think when they retire, they don't have to pay taxes anymore.
Yeah.
And it just doesn't work that way. That's one reason that I'm actually, we didn't tell people, but we're actually here together for the second time, I think, in history,
it's
right?
Been a while.
And so I'm here in Topeka in a tax training program right now to learn different ways that we can cut taxes for our clients. And so I think it's going to be more and more relevant because tax rates are as low as you and I are probably ever going to see them.
Yeah. Yeah.
We're going to see them go up from here.
So let's talk a little bit more about how we figure out how our income will be taxed in retirement, because, there are some different places where we can get income and they're taxed a little bit differently depending on where you're pulling that income from, right?
Absolutely. Every one of them's a little bit different. And so let's kind of start with things that we know are going to be what we call ordinary income tax, right? Okay. They're going to be taxed at your ordinary rate, whatever it is. If you're in the 10, 12, 22%, whatever that number is, what you pull out is going to be taxed at that rate. And let's start with the 401ks, right? 401ks, anything that's tax deferred, 401ks, IRAs, they're all going to be taxed at your ordinary income tax rate. Some people don't realize it, but when you take money out of your 401k, if you're taking it directly out for yourself, there is a requirement that they withhold 20%.
Oh, okay.
Right off the top.
Wow.
You don't have a choice when it's coming out of your 401k. Now, coming out of the IRA, you can choose what you want to have withheld when you have it withheld. So those two accounts are typically going to be pre-tax money. You never paid tax on that money. It grows tax deferred, not tax free. And so at some point, we have to start paying tax on that money. That's why they created the required minimum distribution, because Uncle Sam wants his share sometime. And so that's the deal. Now, a lot of people think their Social Security is not going to be taxable.
Right.
Well, there's this formula that IRS put together way back in the early 80s. And so it depends on how much income you make. Some people pay very little on their Social Security, if anything. Other people, 85% of the Social Security ends up being taxable. Exactly. So that's one of those things that comes into play. Your annuities, the pensions, those all end up being taxable in some form or fashion. Where do we get some savings? Where can we see some savings? Well, capital gains.
Okay.
Capital gains don't get taxed at your ordinary rate. If they're long-term capital gains, they actually get to be taxed at the long-term capital gains rate, which is less.
Okay.
So people in the 12% tax bracket, they actually pay 0% on their long-term capital gains. The maximum long-term capital rate is 20%, but you've got to be in that, 25 to 32% ordinary tax bracket to hit that 20% number. So dividends get taxed differently. And then how do we get some tax-free income?
Yeah, that's what everybody
wants
to
some tax-free income,
yes,
right?
Please.
And that's where the Roth comes in, right?
Okay.
So having a Roth IRA, that is after-tax money went in there, it grows, not tax-deferred, folks, but it literally grows tax-free. So when you pull that money out, you don't have to pay IRS a dime.
Mm-hmm.
So that's good news. The other area that you can get some really tax-free income is life insurance.
Okay.
People don't realize that, but cash value life insurance will provide tax-free benefit for folks. And so it's one of those things that gets missed a lot of times, Jen, when we start looking at the best way to create some tax-free income.
Right. And we do want to learn about some of those opportunities because, as you pointed out earlier, the federal income tax rates that we have right now could be the lowest you'll see for the rest of your life. They went down with that 2017 Tax Cuts and Jobs Act, but we know those tax rates are going to expire come 2026. So at this point, it's not a matter of if, but when taxes will go up, right?
It is. It is when. You know, we know. Exactly. I think we calculated you've got about 3 years and taxes are going to go up.
Yeah.
You know, you don't want to assume that you won't be impacted by the government's proposed tax increases because you're not a big corporation and you're not wealthy enough to have to pay more taxes. But I bet just everyone listening today to the show has a few areas where they can tweak a little here to become more tax efficient with their retirement money. And we're learning more about that right now as you and I speak. Mm-hmm. And so, you know, we want to help you understand what some of the potential tax impacts are for your retirement savings, learn ways that you can possibly reduce or eliminate some of those taxes in retirement, and then create that income strategy so that your retirement income lasts as long as you need it to. Look, if you've saved some money for retirement, you've saved at least $250,000 for retirement, folks, give us a call at 863-285-3815 and let's schedule your core retirement design phone consultation. Hey, it's 30 minutes. Walk you through and answer questions that you have about your retirement. We'll tell you things that you may need to correct or change or give you some advice. Absolutely no cost, no obligation. If you've saved at least $250,000 for retirement, again, give us a call, 863-285-3815, and let's schedule your core retirement design phone consultation where we'll make sure that you're on the path to have the retirement you always dreamed of. That number one more time is 863-285-3815.
And remember, it is just a short window of opportunity to take action to keep taxes from taking too much of a bite out of your savings. This could mean tens of thousands of dollars back in your pocket. That number one more time, 863-285-3815. The Statler Financial Radio Show continues in just a moment. Stay with us.
Turn your plans of yesterday into yes today. Don't wait another day for a routine checkup of your retirement plans. Call Statler Financial Services, 863-285-3815. That's 863-285-3815.
This is your captain speaking. We're expecting fair skies, a smooth flight, and about a 85% chance or so of making it to our destination. So sit back, relax, and enjoy the rest of the flight.
Would you stay on that plane? Of course not. Well, do you have a retirement plan where you probably won't run out of money? You need a plan that no matter the destination will help you get to and through retirement successfully. Philip Statler and the team at Statler Financial Services can design a plan to help you get to your destination as comfortably as possible, even if Wall Street or the economy causes some turbulence. Call Philip Statler and the Statler Financial Services team to start working on your plan. 863-285-3815. That's 863-285-3815. Get a plan designed to allow you to sit back, relax, and enjoy the retirement you've worked so hard for. 863-285-3815. Firm offers insurance services, advisory services offered through Statler Financial Services Incorporated, a registered investment advisory firm in the state of Florida. Investing involves risk, including the potential loss of principal.
If you have a retirement plan and would like a second opinion, call Statler Financial Services today. 863-285-3815. That's 863-285-3815.
Thanks for joining us today on the Statler Financial Radio Show. Jen Rezac here alongside Philip Statler. He is president and CEO of Statler Financial Services, and he knows as well as I do that for years, annuities have gotten a bum rap, right? They're too expensive, too many strings attached. Your money's locked up forever. We've heard all the cons of annuities for years, but with private company pensions dying out, the tide is starting to turn with younger baby boomers and even Gen Xers now showing more interest in annuities as part of a retirement strategy. I mean, did you ever think we'd say that, Philip? Gen X wants to know about annuities.
I wouldn't. But I find that interesting because I did have a younger client come in that she inherited some money. And she said, look, I want to make sure we put some of this into an annuity.
Wow. Okay.
Yeah. I just
So you're
really
seeing it. Yeah. You're seeing it. Well, and I've got some numbers here too. So the Alliance for Lifetime Income conducted a survey, and what they found, 9 out of 10 investors said protection is important for their retirement income. So not a big surprise. That seems like a big deal for everybody. But 71% of younger investors were interested in annuities as part of their overall retirement income plan, and you're saying you're seeing this as well. So when you talk to this client, what was some of the rationale, or what do you think is behind this increased interest in annuities, especially among some of the younger people getting ready for retirement?
Well, I think the study kind of showed, and we talked about, you mentioned it at the opening, is that private company pensions are dying out, right? Mm-hmm. So it's one of those things that we've talked about a lot on the show, is that the 3-legged stool is going to a 2-legged stool. And I think what this shows is that the Gen Xers are even seeing that and realizing, hey, I've got to look out for me. I've got to create my own income stream when I get ready to retire. And so I think that has a lot to do with it. And I think that what's really probably pushed it a little bit more now is even with the pandemic. Mm-hmm. I think that, and the study said that the pandemic had a lot to do with it. I think people had time to think, right? Things were different. Yeah. Things were chaotic. And so I think that it caused people to kind of have a mental reset for where they are, what they focus on, what benefits are actually being offered by their employer. And so I think that really took control and has really opened folks' eyes to some of the benefits that annuities have. I mean, we hear in the news all the negative and the cons, but it's those benefits of being able to provide lifetime income that really is starting to be attraction.
Mm-hmm. And when we talk about the benefits, protected income, that is certainly a benefit. Talk about the difference between that protected income, something like a pension or an annuity, and then that quote unquote maybe money, that non-guaranteed income when it comes to what you're counting on in retirement.
So let's look at it this way. So if you have a pension, right, that money's coming in. Some people call it mailbox money. Hey, it's going to hit your bank account every month, right on time. Well, annuities, a lot of them have that same benefit, right? You have some kind of income provision within that annuity. You can turn it on to provide lifetime income, which is then protected income. That's going to be there month in and month out as long as you're around. Versus what they call maybe money, right? That's money that's in the stock market. Mm-hmm. That's money that we don't know. It's going to be up and down. Probably one of the biggest things I ever saw that really opened my eyes was back in 2009. I was meeting with a potential client who on January 1st of 2008, his IRA had $1.5 million in it. Mm-hmm. And when I met with him, his account was down more than 50%. Wow. Mm-hmm. He was taking, when he started, 5% out of that account. Mm-hmm. He never made any adjustments. So by the time I saw him, he was literally taking 10% out of the account. Wow. Mm-hmm. And so the maybe money makes you have to realize that you need to be able to make adjustments, right? If that's going to be your money and the stock market's down 50%, you need to take 50% less money out of there, if not more.
Wow.
Less than that, right? So that's the difference. Protected income, hey, it's there, it's going to be there, no matter what. Maybe money, it may or may not be there. You may have to make adjustments with that money. That's the biggest difference.
So some clear challenges there for people who are potentially relying on that maybe money instead of something protected, like an annuity or pension or something like that.
Absolutely. If you have maybe money and that's what you're relying on as your monthly stream of income, and there's a lot of folks out there that's what they have. That's, either one, they don't believe in annuities, or two, they're not working with a financial advisor who knows how to do distribution planning properly for safety versus risk. And they don't have that. So they're taking money out of their risk bucket, their maybe money bucket. And the problem is if they don't make adjustments when the market declines, then they may run out of money faster than what they had planned on. Folks, listen, that's why I believe it's so important that you have a written retirement income plan. If you don't have a written retirement income plan, then you're just taking money kind of out of your junk drawer. You're taking out this product or that product or this account or that account without a plan in place. It's the retirement income plan, a written plan, that gives you certainty around your money and that income distribution coming out. Give us a call at 863-285-3815. Sit down with us and let us help you put together that written retirement income plan. That number again is 863-285-3815.
Talking today with Philip Statler. He is president and CEO of Statler Financial Services. I am Jen Rezac alongside. And when you talk about having that retirement income plan, does simply owning an annuity, does that count? Is that what you mean when you talk about having an income plan? Because that sounds like the plan for where your income's coming from.
And it may be where some of your income's coming from, but that's not the plan.
Okay.
That would be like, open up a junk drawer and say, I need tape, so I'm going to take this roll of tape. Well, no, you need to have a plan, a written retirement plan, so that you know where your money's going to come from and where it's going to come from. So that's really, we use at Statler Financial, we use a bucket approach. So we've got buckets of money. We know when you're going to start bucket one, how long that's going to last, when we're going to go to bucket two, how long that's going to last, how long the third bucket's going to last the rest of your lifetime. So we've got different buckets of money. That's a plan. And knowing exactly when you're going to turn that bucket on and when you're going to have to switch to the next bucket, that's a plan. That's not just picking money out of one place or another. And that's important that people have that written down, that written retirement plan down.
How do we find the right balance between protection, having that protected income, but then also still getting a little bit of growth in some areas of our money? Because it seems like when you look at how long people are living and things like inflation, costs keep going up, growth still seems important. How do you find the right balance?
That's a good question, Jen. So everybody's different. But we start out that process here, we use the rule of 100. Now, that may or may not be where we end up, but it's definitely where we're going to start. So we're going to say, hey, we're going to take your age. If you're 65 years old, subtract that from 100, 35 is what's left. So 35% is about what we would want invested in the risk bucket of money. And so that means we got 65% plus or minus 10% protected and safe. And that just is kind of a rule of thumb. It's not in stone. We make changes all the time. But we take that along with walking through a smart risk tolerance process to determine how much risk you can really handle on the ups and downs of the marketplace is kind of how we determine what that balance needs to look like.
If we are thinking about an annuity or putting our money in any type of retirement planning vehicle, no matter what we're thinking of investing in or rolling it into or putting it, how do we get a second opinion?
Yeah, they can give us a call. We'd be happy to sit down with them and say, look, that's a good vehicle. There's some better vehicles out there. Here's what I see being really in this industry is that there's some sweet spots right now when it comes to annuities. Everybody, it used to be, the 10-year annuity had the best rates, the best deals. I'm not really finding that now, Jen. The 7-year annuities actually right now have a better opportunities for earnings. And so I tell people, look, I'd be happy to sit down with you, look at what you're looking at, and give you the pros and cons of that, and let you know if that really is a good place to park some money for income. Again, that's easy. I'd love to do it, give you a second opinion on that. All you have to do is give us a call at 863-285-3815 to get started with that. But that annuity part, Jen, is only part of the whole plan. Mm-hmm. I sit down with people all the time that they have too much risk in their portfolio. I mean, that's not uncommon. But the other thing that I see, not as often, but I see people who don't have enough risk in their portfolio. They've got everything in CDs or annuities. And that's just as bad as having too much risk. So it's a balancing act. We need to have both things within our portfolio to make sure that what we have is going to last throughout your lifetime. Now, the other part of that is the risk bucket can't just be set it and forget it, right? It's got to be something that's monitored, controlled, rebalanced on a regular basis, and monitored to the nth degree. That's what makes the risk bucket work the way it needs to work. And so that's why we developed our whole core retirement design process, is to build that core for folks, to balance between risk and safety. That's the whole emphasis that's on that process. And give us a call. Look, if you've got $150,000 or more that you've saved for retirement, give us a call at 863-285-3815. Again, that number is 863-285-3815.
Talking today with Philip Statler. He is with Statler Financial Services. An annuity may or may not be right for you, but one thing is certain. Today's annuities are a world away from the ones your grandparents have. We'll get into that on the other side of the break. Stay with us.
If you have a retirement plan and would like a second opinion, call Statler Financial Services today. 863-285-3815. That's 863-285-3815.
From the pitch, swung at a little too soon.
Strike three, you're out.
To the joke told at the wrong time. To barely missing your connecting flight.
This is the final boarding call for Flight 109 to Chicago.
Timing is everything. The same is true for your Social Security benefits. Take them too soon and you could leave a lot of money on the table. Take them too late and you might spend down too much of your savings. Everybody's situation can be different, but taking your Social Security benefits at the right time is important for your retirement success. Philip Statler at Statler Financial understands Social Security and can help you make decisions that are best for you and your retirement dreams. Call 863-285-3815 to start optimizing your benefits. With Social Security, timing is everything, so don't delay. Call Philip Statler at Statler Financial today. 863-285-3815. That's 863-285-3815. Our firm offers insurance services and is not affiliated with the U.S. government. Advisory services offered through Statler Financial Services, Inc., a registered investment advisory firm in the state of Florida.
Thanks for joining us today on the Statler Financial Radio Show. I am Jen Rezac, happy to be here with Philip Statler. He is the inaugural Highlander Award winner for Financial Representative of the Year. He is president and CEO of Statler Financial Services in Sebring. An annuity may or may not be right for you, but one thing is certain. What we have today, these annuities are a world away from the ones your grandparents have. I mean, Philip, talk about that. How much has changed with the income tools we have today for the modern retiree?
Yeah, there's a lot of different. I mean, even Jen, I think back the 23, 20, well, somewhere in that ballpark, not quite 20 years that I've been using annuities. It's amazing how much they've changed even in that time period. So, who knows what we got to look for the next 20 years.
Yeah, exactly. And one of the most confusing aspects of annuities is that there are so many different types. And that's something that has really come a long way as well. Could you just go over the different kinds of annuities that are available today? Because I just think there's some confusion there.
Absolutely. So when we look at annuities, there's 4 main types that are out there, and each kind determines a different monthly payout. So the key thing to remember is that annuities create a stream of income at some point in your life. Now, the first one is an immediate annuity. An immediate annuity, you dump a bunch of money into an insurance company's pocket. And that company will spit out monthly income or annual income or quarterly income, whatever you've agreed to, for a couple of things. Either you can set up on a term, like they're going to do it for 10 years, or you can set it up for your lifetime. Either way, you're trading a bunch of money that you give the insurance company for a income stream at some point in time. It's kind of creating your pension, right? You dump it in and you're going to get a stream of income, and you can do joint and survivor life if you want to. So it would tie up 2 people's lives before it runs out. And then there's a deferred annuity. So with a deferred annuity, you put money in either all at once, or you can put some in along the way over time. But at some point in the future, a stream of income begins, right? The deferred annuity is just that. It's going to be an income stream at some point down the road. The difference is that you pick a time later in life. And so some of the TSAs, the tax savings annuities that teachers have, especially some of the older ones, are deferred annuities. That the only way they really get their money out of there is a stream of income. Then you go to fixed annuities, and there's a fixed interest rate, right, that's associated with that contract. And so when the index is up, your index is up. So there's 2 types of fixed annuities. Let's look at that, right? There's the old-fashioned fixed annuity. Hey, I'm going to make 5%, or I'm going to make 2%, whatever it is, for 5 years or 10 years or whatever. Then there's an index annuity where your rate of return is determined by an index. So if that index is up, like the S&P 500, if it's up, you make so much money. Not all of what the S&P, so let's say you make 30% of what the S&P 500 does. So if it's up 10, you're going to make 3.3. And it resets usually every year. There's multiple indexes available in today's index annuity world, and you can usually reallocate between those indexes on an annual basis if you feel the need. Then the last one is the variable annuity. And the variable annuity are for investors willing to take more risk, because there's no real guarantees in terms of principal unless you buy some type of rider that provides that for you. So the way the contract is valued is it's a variable investment, right? It's a mutual funds within inside that annuity wrapper. So it's just like being in the stock market. The account value will fluctuate based on how well the stock markets are doing and how well the investments are doing. This type of annuity can offer higher returns, but with the possibility of your account actually falling in value and being worth less than what you put in.
So a lot to know there with so many different varieties of annuities, so many different flavors. How do you know which one would make the most sense if one is right for you?
Well, that's a little difficult to say, right? Because it all depends on everybody's circumstances. It depends on what's important to them. What are they seeking? Are they seeking more risk? Are they seeking less risk? What are their drivers? And that's really the bottom line, Jen, is we've got to come up with what's important to them? What are they trying to accomplish? Because that determines how you allocate between annuity or the stock market. The whole thing is really and truly an individualized process. There's no basics, hey, we can throw this out as in general, everybody can do this. That's not the way it works. The whole income planning process is very individualized. And that's what we strive for our clients to do, is to put each individual client has a different plan. There's no cookie cutter situation that we can just stamp out and say, oh, this will work for you, and this will work for you, and this will work for you. Every one of them, we start from scratch and build it based on the specific needs of that client. So that all goes to the process of, you need to have a written retirement income plan. You need to understand what you have in risk. You need our core retirement design to make sure you're on the right path. To schedule your time, just give us a call at 863-285-3815. That's 863-285-3815.
Talking today with Philip Statler. He is president and CEO of Statler Financial Services. And I know fees are a big concern for a lot of consumers as well. What do we need to know there, Philip, about the fees that could potentially be there with an annuity?
So fees will also depend on the type of plan you choose. Index annuity fees can range from 1% to 2%. Variable annuity fees, the article I read said up to 4%, but I've seen a variable annuity that had over a 5% in fees, because they had so many different riders that were attached to it. Additional death benefits or income benefits can also add to that cost. So companies may take a share of the gains and reduce your return on a sliding scale for some protections on the downside. There are also no fee annuities that only take a share of the gains. So there's different ones out there. I look at it as, what is the issue I'm trying to solve for? And then go and find the best solution for that situation. You don't want to be tied down to any one annuity company. You want somebody that's going to give you options and all the different things that are out there, Jen, because there's no one company that writes all the best annuities, Jen.
If we already have one, are we locked in? Are we stuck with this for good? Or can we potentially make changes if we're interested in shopping around a little bit?
It depends. Okay. You're not locked in forever. Usually, I will say that, because you could be, right. If you have a immediate annuity, well, you're stuck. That's whatever you did. It's done contractually. If you have a deferred annuity that's going to pay income out later, you're stuck. The only way to get the max benefits out of it is to take an income stream. I guess you can cash them in early sometimes, but you take a huge penalty. It's not worth it.
Okay.
It really does depend on the annuity itself. But in general, most of the time an annuity is going to have a 5 to 10 year time period on it, that the contract is locked in and has some penalties attached if you leave early. And after that time, typically you can make changes and find a better annuity, a better mousetrap, that may be out there. So, but each contract's different. You have to really look through the language to make sure you're making the right decision.
Walk us through your process for doing an analysis on an annuity for us.
So we look at, one is how long is the annuity and when do you need to start taking money out of it? That's number one. Number two, do we have a lot of choices with the type of indexes that are available to us? Or are we locked into the famous 3, the S&P 500, the NASDAQ, or the Dow Jones 30? We want more variety is what we look for, because those varieties can provide us with some better returns than just those old standard three. And then from there, we're going to look at something that's that gives us the best opportunity. And we have different tools that we use that will back test different annuities, that will say, hey, look, based on, the last 20 years, this is what this annuity would have done had you used certain indexes. Not that that's locked in stone, but at least it gives us a guide for going forward. And the bottom line is that you need to walk through a process. It's not buying a car, right? We need to understand that having that annuity is only part of the process, and nobody should have everything invested in just annuities. It doesn't make financial sense. It just doesn't make sense at all. But I see it. I see it on a regular basis. It's walking through that process. It's having that core retirement design so that you understand where your income is going to come from, what the risk is that you have. All these things are important as we try to determine what you need and how you need it to work for you. Listen, folks, if you have at least $150,000 saved for retirement, let us walk you through our core retirement design to make sure that you're on track and that you're covering all the bases as you get ready to retire, or if you've already retired. Give us a call at 863-285-3815. That's 863-285-3815.
This is the Statler Financial Radio Show. We'll be back.
This is your captain speaking. We're expecting fair skies, a smooth flight, and about a 85% chance or so of making it to our destination. So sit back, relax, and enjoy the rest of the flight.
Would you stay on that plane? Of course not. Well, do you have a retirement plan where you probably won't run out of money? You need a plan that no matter the destination will help you get to and through retirement successfully. Philip Statler and the team at Statler Financial Services can design a plan to help you get to your destination as comfortably as possible, even if Wall Street or the economy causes some turbulence. Call Philip Statler and the Statler Financial Services team to start working on your plan. 863-285-3815. That's 863-285-3815. Get a plan designed to allow you to sit back, relax, and enjoy the retirement you've worked so hard for. 863-285-3815. Firm offers insurance services, advisory services offered through Statler Financial Services Incorporated, a registered investment advisory firm in the state of Florida. Investing involves risk, including the potential loss of principal.
Thanks for joining us today on the Statler Financial Radio Show. I am Jen Rezac, happy to be here alongside Philip Statler. He is president and CEO of Statler Financial Services. Philip is the inaugural Highlander Award winner for Financial Representative of the Year. He gets questions from people all the time about all things retirement. So, Philip, we have a collection of people. We went out, got some common retirement questions. We figure if these folks have questions about these things, you listening probably do too. So what do you say, Philip? Should we get into our Man on the Street segment and hear the questions that the people out there have?
Absolutely. We'll see what kind of questions they have today.
Yeah, we have a good collection of them today. Our first question, we ran into Al, and here's his question.
Hey, so my buddy down the street keeps bringing up this investment over and over and over again. He's excited about it. He swears by it. I'm interested, but I'm also concerned because I really don't know a whole lot about it. So what would be the best way to research something like that? Because I've always heard that you should always understand what you're investing in.
Absolutely, Al, definitely. You do want to understand what you're investing in. And one way to do that is to do some research, right? So Google sometimes can be a bad thing, but Google the company, see what kind of articles there are out there to read about. Other than that, you need to go to the company's website. They usually will have an investment relations section on there. See if you can't get their income, their financial statements, I would say read the prospectus, but you'd go to sleep if you read the prospectus. But I would say look at what analysts have to say. Look at some different analysts that might be following that company to make sure what they say. Are they buying it? Are they selling it? Are they holding it? These are all some ways that you can at least get some idea about the company. But remember this, Al. Just because your friend, your brother-in-law, or some family member is making an investment, their financial situation could be totally different than yours. And so you need to look at it from your perspective, not from their perspective, and make sure that they're not trying to sell you something that they're going to benefit from. That's the other thing I'd warn you about.
All right. Good question, though. Certainly something to keep in mind, I think, as well, Philip, that there might be something that's worked really well for our brother-in-law or our neighbor or our coworker. But again, that doesn't necessarily mean that it's right for us. So just another thing.
That's right, Jen. And it could be they bought it 6-8 months ago, and now it's not the time to buy it.
Yeah,
right?
they got it at the right time.
Right.
Why
go buy it now?
Right, exactly. So, yeah. Lot of things to think about there. Next question is from Pete, and I'll let Pete ask the question. Here we go.
I'm a freelancer, and I've always had enough income, but I don't have a company 401k that I can contribute to. So what are some options for me when it comes to saving for retirement? I'm 47, so I do have some time, but I don't want to put it off any longer.
I'm glad you don't want to put off any longer. That's a good sign. So, you are self-employed. You have a Schedule C. You have your own business as a freelancer. And so there are a lot of different options out there for you to create your own retirement plan. You can do a solo 401k. You can do a simple plan. You can do a SEP. So which one of those is going to work best for you? I don't know without sitting down with you to really look at your tax returns and look at your net worth to really kind of make that determination. I'd love to do that and help you with that process if you'd like. But there's a lot of retirement options out there. I would think between a financial advisor and a tax person, you could figure out which one would be best for your circumstances.
All right. Great question. And let's just go through that real quickly as you talk about that process for helping people determine the right options. Philip, can you just tell us about that real quickly before we move on to our next question?
Absolutely. When we're sitting down with folks, there's a lot of things that have to go into making financial decisions. And so we look at, how much do you have in your IRAs or your retirement accounts? How much do you have that's not in your IRAs and retirement accounts that you have access to now? How much are you going to need to live off of in retirement? And then what's your current tax situation? Because we want to make tax sensitive recommendations when we sit down with folks to do these things. And so really and truly, for me, I believe people have to know where they are right now in order to know if they need to make any changes. And so many folks I sit down with don't really know where they are right now. They don't know how much risk is in their portfolio. They don't know how much they're paying in fees and expenses. And so you can't move forward unless you know where you are moving from. And so that's really the first part of our process, Jen, is determining that. And then from there, we decide what road we need to go down. Is, tax planning more important? Do we need to do retirement planning? Or is it time now to start doing retirement income planning and get ready for that final quarter of the game that we're going to retire?
Talking today with Philip Statler. He is president and CEO of Statler Financial Services. This is our man on the street, or I guess men and women on the street part of the show, because our next question comes from Roberta. And let's take a listen to what she's worried about.
Oh, lately, all the negative news has just been overwhelming, and I just want to tune everything out. But I know it's really important to stay informed. What should I do?
Good question. Good point. It is tough, right, to stay focused and to not let all the outside noise really get us down on what's happening out there. So, I get this phone call quite often in the time we are right now with all the negativity going on out there. I get this phone call. Are we invested properly? Do we need to get out of the market right now? So here's what I tell my clients, because I know it's true for a fact that what's happening in the indexes that they see on the news is not what's happening in their portfolio, right? That we don't just own the S&P 500, the Dow 30, and the NASDAQ. That's not where we are. And so your portfolio may look a little bit like that, but it doesn't look exactly like that. And so, I tell people that's why you have a plan in place, is to walk through these up and down times. And so trusting your financial coach that he's made the right choices for you and that he's sitting down with you on a regular, periodic basis to ease those fears. That's huge, right? Is being available to kind of walk through that to make sure that you're getting your questions answered, that, he understands your concern, and that the portfolio that he's using or the investments he's using is addressing that concern that you currently have. And that's important to make sure you're working with the right person too, that's going to give you that, right? And so I would think that's a lot of it. Mm-hmm. But sitting down with your financial advisor on a periodic basis, just to make sure that you're being heard and to make sure that your portfolio and what you intended to do, right? That's just so important.
So a great collection of questions here today, very diverse set of questions. And I do think it's important when we look at a question like Jan's, this is a lot of people. We're just busy with life. We haven't, so many times we're so busy thinking about what we're dealing with right now and tomorrow and next week. It can be hard to think about retirement down the road. So Philip, I guess, what's your final message for our listeners here today and for people who do have questions? They do want to make sure that they're on the right track. What should those folks be thinking about?
I think that no matter where you are in life, we need to think about the end game. The end game is at some point we're going to retire. So what do we need to do to prepare for that? And there's going to be bumps along the way. We're going to have kids. We're going to have to put them through school. We're going to have to get them through college. And then we may have job changes. We might have other health issues. There's a lot of things that could be bumps in the road. But by having some kind of plan in place that you sit down and look at least once a year, even if you're younger, having that financial plan, that roadmap to your financial freedom, I call it, in retirement, is huge. And that's a good starting place to kind of know where you need to be and when you need to be there. It allows you to tweak things along the way as we continue to make improvements towards our retirement. It allows you to get back on track if you get off the track, because now you know what that track looks like. Folks, listen, if you're not sure about your retirement, if you're not sure where you are today in terms of risk in your portfolio, expenses you're paying, will it be enough? All the questions that I know go through your head as you start to think about retirement. Give us a call at 863-285-3815. That number is 863-285-3815. Don't procrastinate. Don't put it off any longer. Pick up the phone. Give us a call. 863-285-3815.
You've been listening to the Statler Financial Radio Show. Thanks for joining us here today. We hope you have a great week.
Turn your plans of yesterday into yes today. Don't wait another day for a routine checkup of your retirement plans. Call Statler Financial Services, 863-285-3815. That's 863-285-3815.
Information provided during the Statler Financial Radio Show is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. All investing involves risk, including the potential loss of principal. No strategy is guaranteed to be successful.
This radio show is a paid placement.